Hello and welcome back to the channel. I am Abhishek and I am thrilled to have you join me for another review lecture for CFA Level 1 2025. Today's topic is the behavioral biases of individuals. I'll cover all the key concepts so that you can feel confident while attempting the exam. If you find this video useful, please hit the like button and subscribe to the channel. And as always, if you have any questions, please drop them in the comment section below. Now let's jump right in. So we'll compare the cognitive errors and emotional biases in this reading, and then we'll discuss some commonly recognized behavioral biases. And at the last, we'll see how these behavioral biases result in market anomalies. So why the behavioral biases occur in the first place? See, people, they depend upon basic judgment and preferences, and they try to simplify the situation rather than acting completely rationally. What I mean by acting completely rationally is whenever you face a complex problem, you should first be able to critically analyze the problem and then decide what's your best course of action. But instead of that, what we try to do is we simplify the situation and depend upon our basic judgment skills to make decisions. And this leads to suboptimal outcomes and suboptimal decisions. But the traditional finance theory, it assumes that individuals always act rationally, which contradicts how individuals actually perform, how individuals actually behave while investing. So the behavioral biases, they come in two forms. First is your cognitive errors. Cognitive errors occur when there is a faulty cognitive reasoning behind your decisions. And second is your emotional biases. Emotional biases, they are based on feelings and emotions of individuals. Since cognitive errors are the result of faulty cognitive reasoning, they can be corrected or eliminated through better information, education, or advice. Whereas the emotional biases, they are harder to correct because they stem from your impulses and intuitions. They arise spontaneously rather than through conscious efforts. The cognitive errors are classified into two categories. First is your belief perseverance biases. Second is your processing errors. In belief perseverance biases, it's basically the tendency to cling to one's previously held beliefs, and you simply discard the new information or you discard the information that contradicts your beliefs. So why this happens? It happens because of the effort that you need to analyze the new information. People generally discard the new information because it's conflicting with your previously held beliefs. This situation is known as cognitive dissonance. When you discard the new information because this new information is conflicting your previously held beliefs, and it's creating a sort of mental discomfort for you. The biases which come under belief perseverance are conservatism bias, confirmation bias, representativeness bias, illusion of control bias, and hindsight bias. We'll discuss each of these biases in detail later. Then comes processing errors. In processing errors, it basically describes that how your information is being processed. So in this case, you are processing the information, but you are processing it illogically or irrationally. The processing error biases are anchoring and adjustment bias, your mental accounting bias, framing bias, and availability bias. Let's first talk about conservatism bias. So, in conservatism bias, people maintain their prior views or forecast by inadequately incorporating new or conflicting information. So, they don't incorporate the new conflicting information properly and they stick to their own beliefs. Now, what are the consequences of conservatism bias? You may be slow to update your view or forecast. So if you get some new information which is impacting your forecast, but you don't include that information and you maintain your previous forecast, or you can maintain a prior belief rather than deal with the stress of updating your beliefs given the complex data. If you receive some complex data, it could be possible that you are discarding the new information, because to process that information you would have to exert some mental effort. So you just discard that information and keep your prior beliefs, keep your prior estimates as it is. How you can detect and how you can overcome the conservatism bias? It can be corrected by properly analyzing and weighting new information. Whenever you receive a new information, you need to critically analyze it and critically weight it so that it can properly reflect in your analysis. Then comes confirmation bias. See, in conservatism bias, we completely ignore the new information, right? But in confirmation bias, what happens? We only notice the new information which confirms our prior beliefs or prior estimates. Like if I have given an estimate for a particular stock, the information which is confirming that estimate, I'll include that in my analysis. But the information which contradicts my previous estimate, I'll discard that information. So it's the tendency to notice what confirms your prior belief and to ignore whatever contradicts your prior belief. What could be the consequences? You are only considering the positive information about an existing investment, because see, you are already invested in that instrument. So you are only considering the positive information which is confirming your investments. You develop a screening criteria while ignoring the information that can contradict the validity of your criteria. Your portfolio could be under diversified. You could hold a disproportionate amount of investment in your own employing company's stock because you believe that your company and you have favorable prospects in the same industry, in the same company. You believe that your company can do good in the coming future. So you keep all your assets invested in the same company. How you can detect and how you can overcome the confirmation bias? By actively seeking out the information which challenges your existing beliefs or which challenges your existing estimates. So you seek out some such information which is challenging for you. Then comes representativeness bias. So representativeness bias, it's the tendency to classify new information based upon your own past experiences and classifications. For example, let's say if there's someone who has made who made only losses in the stock market, and there's second person who's made only profits in the stock market. So if you go to the first person and ask him that how does the stock market work, he'll tell you that stock market is a complete gamble, right? Because he has not made money out of it. So he'll classify the information, he'll classify the stock market based upon his own personal experiences. And the second person will tell you that stock market is a money making machine because he's never lost a dime in the stock market. So he's classifying the same stock market according to his own personal experiences. So that is your representativeness bias. When you classify the new information based upon your own past experiences and classifications. What are the consequences of this bias? You adopt a view or forecast based exclusively on your individual and specific information. You update your beliefs using simple classifications rather than dealing with the stress of updating your beliefs. Because whenever you are classifying new information, you have to exert some mental effort to classify that complex data, to process that complex data. So rather than dealing with that mental stress, you use your own past experiences to classify the new information. How you can detect and how you can overcome representativeness bias? By widening your sample size. Just like the example that I gave you, there were only two persons. One had his own experiences, the other had completely different experience with the stock market. So you need to widen your sample size, and you need to do more research to obtain a base rate information. What's the base rate? Base rate is basically the average of all. So if you are talking about stock market, if you want to see that how stock market generates money, how many people make money in the stock market, you would have to look at the complete investors database. Then comes illusion of control bias. Illusion of control, it basically refers to the tendency of people to believe that they can control or influence the outcomes. But in reality, you cannot control or influence the outcomes. Stock market, it's based upon probability. You cannot control the outcomes when you are investing. You cannot say that yes, this is good stock, I'll invest in this stock and I'll make some money. This is not under your control. That same stock which seems good to you can lose money also. What are the consequences of illusion of control? You may inadequately diversify your portfolio because you believe that the stocks that you are choosing, they will make money. So it's possible that you inadequately diversify your portfolio. That means you make some concentrated bets. If you have illusion of control, you can trade more than is required, because if you believe your own forecasting skills, you think that you can control your forecast, you can control the outcomes of your investments, then you will trade more. You can construct complex financial models. So these complex financial models will can make you feel that yes, you can control the outcomes, but you cannot control the outcomes in reality. The complex models will not help you to invest better. They will not help you to earn a higher return. How you can detect and overcome illusion of control bias? The basic idea is that investors need to recognize that investing is a probabilistic activity. You cannot control the outcome of an investment. You cannot say in advance that yes, this stock is good, it will generate this much return in the coming future. No, you cannot say that. Instead, you can say that there are 50% chances that this stock can go up, there are 50% chances that this stock can go down. But if that stock is very good, the probability of going high increases. Then it becomes probable that there could be 70% chances that the stock can go up and 30% chances that the stock can go down. But still, there are some chances that the stock can go down, even if it's a good stock. So, investing overall is a probabilistic activity. Now, let's talk about the hindsight bias. So, hindsight bias, it refers to believing the past events that they were predictable and they were reasonable to expect. For example, when the COVID came, every stock market in the world plummeted. So, all the stock markets were down approximately 25 to 30% at that point of time. That at that time, no one was sure that how much time will it take for the COVID to completely for the stock market to bounce back. No one was sure at that point of time. But if you see how the stock market performed after that period, and you are analyzing that period, let's say in 2025, you would want to believe that yes, since the market was down 30%, it was really predictable that the market will bounce back one day. But if you see that the persons who were investing at that point of time in 2020, they were not so sure about it at that point of time, because the things were so uncertain at that time that it made no sense in putting your own money into the stock market. So everyone was behind the safe assets at that point of time. But if you see that event after it has happened, you will see, you can say, you would want to say that yes, the market was down, so it was sure that the market will bounce back one day. So you are seeing the past events and you are believing that that event was predictable and it was reasonable to expect that the market will bounce back. So what are the consequences of hindsight bias? You overestimate the degree to which you can correctly predict your investment outcome. If your predictions in the past had turned out to be true, you would think that yes, your predictions are good. You will overestimate your own ability to predict an investment outcome. How you can detect and overcome the hindsight bias? You should carefully record your investment decisions and the reasons for making those decisions. Because whenever you are making the decisions, situation is different at that point of time, and after your investment results are out, after your stock portfolio has performed better or worse, the situation is different at that point of time. So you need to completely analyze your decisions, that why you made these particular investment decisions. This analysis will help you overcome your hindsight bias, overcome your overestimation of your overconfidence on your own prediction ability. Now let's talk about the cognitive errors. First is your anchoring and adjustment bias. So anchoring and adjustment bias, it basically refers to relying on your initial piece of information to make subsequent estimates or judgments. Now, since you are making the subsequent estimates or judgments, it's more probable that your adjustments are not adequate. For example, let's say if there's a particular, if there's a company which is going, if there's a company which wants to sell its assets, let's say the company has gone bankrupt, it's looking for an acquirer. Let's say the company is asking, the management is asking a valuation of $100 million. This was the initial price that the company set, and you are analyzing this company for your for acquisition, right? You want to buy this company out, and you are analyzing this company and its future prospects. You come to know that there's some hope that this company will revive in the long term. That you expect the company to perform better after 1 or 2 years. So this positive information, let's say if you forget this $100 million point, this is your anchor. This initial price, it works as an anchor for you, because now whenever you will analyzing the company, you will see that how the company is performing. Is the company more valuable than $100 million or less valuable than $100 million? So let's say you get some positive information about the company and you think that the company is going to be more valuable than $100 million. You will adjust your price a little bit. For in that case, let's say you adjust it for $5 million, so your new price becomes $105 million. But instead of $105 million, if you had forgotten the $100 million, if you have completely discarded this $100 million point, you and you do some free cash flow analysis, some DCF analysis, and you could have find out that the value of the company was $140 million. But instead of doing that analysis, instead of doing a proper analysis of the company, you just relied on your initial piece of information, which was $100 million, and you adjusted your estimate based upon your initial piece of information, which this initial piece of information, it's working as an anchor for you. So your mind is stuck at the $100 million point. Whenever you are valuing the company, you will see whether it's more valuable than $100 million or it's less valuable than $100 million. You will not see its absolute value. What are the consequences of such an this anchoring and adjustment bias? You may stick too closely to your original estimates when you are learning new information. how you can detect and overcome this bias? You should examine the basis of any investment recommendations to see if it's anchored to previous estimate or some default number or not. Like in this case, our 105 million estimate, it was anchored to $100 million because we were only considering $100 million as our starting point, and then we made some adjustment to this starting point, and we came at $105 million point. But this $105 million, it's way too low than the actual value of the company, which is $140 million. So this $100 million, it's working as an anchor in this case. Then comes your mental accounting bias. Now, what's mental accounting bias? Mental accounting bias, it basically refers that mentally you are dividing your net worth into different accounts, and that influences your decisions. Even though your all net worth is fungible, that is just the you need to look at the whole picture. Like, say you are worth $1 million, so $1 million is your net worth. You need to make investment decisions based upon $1 million. But instead of doing that, let's say out of $1 million, 500,000 is invested in real estate, 200,000 is invested in your retirement account, and in your equity portfolio you have $300,000. So while investing, you are considering that 500,000 is different account, 200,000 is in my retirement account, that is a safe asset, and I'll be concentrating on just $300,000. So that is a mental accounting. You have divided your money into three different accounts and you are treating them differently. What are the consequences of mental accounting bias? You neglect the opportunities to reduce risk by combining assets with low correlations. In this case, 50% of your assets are invested into real estates. So for your equity portfolio, you should have invested in the assets which were negatively correlated with the real estate, so that overall your risk reduces. Your overall risk for your 1 million portfolio should reduce. But since you are only focusing on $300,000, it could be possible that you invest in such instruments which have a positive correlation with your real estate investment. So it's actually increasing your risk. You irrationally distinguish between the returns derived from income and those derived from capital appreciation. But see, if you think critically, the income that you are getting from dividends, that is just the same as the income that you get from capital appreciation. But people generally prefer income from the dividends. They prefer to have some cash credited into their account. So they treat capital appreciation and dividends differently. You irrationally bifurcate your wealth or portfolio into investment principles and investment returns. So what this means, let's say you invested $100,000 into a particular investment, and after 1 year, that $100,000 has now become $150,000. Now, after 1 year, your total portfolio is $150,000. So you should treat that portfolio as one. But instead of doing that, you are saying that $100,000 was my principal, $50,000 is my gain on that principal. So I can take higher risk with $50,000 and I'll put $100,000 into safe assets. That is my principle. I'm preserving that principle, which is a wrong approach because you have bifurcated your portfolio into investment principal and investment returns, whereas $150,000 should be treated as the whole portfolio. You should have looked at the whole picture. How you can detect and overcome the mental accounting bias? You should go through the exercise of combining all your assets into one spreadsheet to see the holistic asset allocation, that how much of your total portfolio is invested into which assets. Only after that you can make good investment decisions depending upon the whole portfolio. Then comes framing bias. The framing bias, it basically refers to the situation in which a person answers the question differently based upon how it's asked or framed. If someone is asking you a question in a positive sense, you answer differently. And if someone asks you a question in a negative sense, then your answer differs. So that is your framing bias. That depending upon how the question is framed, your answer differs. Narrow framing is one part of framing bias. Narrow framing occurs when people evaluate information based upon a narrow frame of reference. That is, instead of looking at the whole picture, you are just focusing on one or two specific points. Let's say if a company has a good management record and but the company is doing poorly operationally, so instead of looking at the complete picture, you are just focusing on the management's capabilities. You are saying that the management is capable, so this is a good company. But in reality, that good management is not being able to translate good management decisions into good operations. So you should look at a complete picture. What are the consequences of framing bias? You may misidentify your risk tolerance levels because your answers will differ upon how the questions about risk tolerance were framed. If someone is presented with a gain reference of frame of reference, you could become more risk averse. But instead, if someone is being questioned on a loss frame of reference, they can become a more risk seeking investors. So this misidentification could result in suboptimal portfolios. Narrow framing could result in that focus being on the short term price fluctuations. It could result in long term considerations being ignored in your decision making process. Let's say if a management is just focusing on the shareholder wealth, they could focus on the quarter to quarter performance. Instead of making long term decisions, instead of making long term strategies, they are just focusing on short term fluctuations in the stock price. How you can detect and overcome the framing bias? You should try to eliminate any reference to gains or losses that have already occurred. You should focus on the future prospects of the investment and try to be as open minded as possible when you are interpreting the investment related situations. You should not see that this is the gain that I made on this investment, this is the loss that I made on this investment. Instead of that, just see what are the future prospects of this investment so that you can make good rational decisions. Then comes your availability bias. What's an availability bias? It's an information processing bias in which people estimate the probability of an outcome based upon how easily the information is recalled in your brain. So if someone asks you a question about the probability of stock market going down 30%, and if recently, let's say in January to March or April, the markets were down approximately 20 to 25% all over the world. So you think that it has a higher chance of market going down 30%. But let's say when the markets are going up and then someone asks you that what are the chances of a stock market going down 30%, you would say that there are negligible chances of the market going down 30% because at that point of time you cannot easily recall that the when the markets were down 30%. But if the markets were down 30% recently, then it's more easily recallable and you will predict the probability to be higher in the later case. So availability bias comes out of four factors. The first factor is your retrievability. If the idea comes to your mind more quickly, then that means that will be chosen as a correct option, even if it's not in the reality. Second is categorization. When you're solving problems, you gather information from what you perceive as your relevant search sets. Those search sets are coded into your brain, like depending upon your previous experiences, depending upon your education, depending upon your experiences. So these different problems require different search sets. So it's difficult to come with a search set because the object of the search is difficult to categorize. If it's difficult to come with a search set because you had no experience with that particular problem, you will estimate the probability to be lower. Then comes your narrow range of experience. It's possible that a person may use only a narrow range of experience instead of considering your multiple perspectives, that you are not considering the whole perspectives, you are just considering a narrow range of experience, the your own personal experience. Resonance, it's when people are often biased by how closely a situation parallels their own personal situation. If this situation is just as similar to as your own personal situation, the availability becomes higher, the bias becomes higher. What are the consequences of availability bias? You can choose an investment or mutual fund based upon the advertising or the quantity of news coverage. That means if you had seen the advertisement of that mutual fund multiple times over the last few days, it's more probable that you will select the same mutual fund when you are investing the funds. How to detect and overcome availability bias? You need to develop an appropriate investment policy strategy. You should carefully research and analyze all your investment decisions before making them, before implementing your decisions. And you should always focus on the long term historical data instead of just referring to the most recent data. These were our cognitive errors. Now let's talk about emotional biases. Emotional biases are harder to correct, as I already told you, because they originate from your impulses or intuitions, and they don't result from your conscious calculations. The first bias is loss aversion bias. Loss aversion bias, it refers to the tendency to strongly prefer avoiding losses to achieving gains. If some person makes a loss of 10,000 and next day he makes a gain of 10,000, the loss of 10,000 will be much more painful than the happiness that he gets from a 10,000 gain. It leads the investors to hold their losers to avoid recognizing losses, and they sell their winners to lock in profits. What's the disposition effect? It's very much related to the loss aversion bias. It basically says that you hold the investments which have experienced losses for too long because you are not able to recognize your losses. You do not want to realize your losses. So you keep on holding your losing investments and you sell your investments that have experienced gains. So once you do that, your portfolio will be consisting of risky securities which have lost value. So you will be holding the losers only. What are the consequences of loss aversion bias? You could hold investments in a loss position longer than that is justified by your analysis. You could sell investments in a gain position earlier than justified by the analysis. So you are selling your winners earlier and you are holding your losers for too long. How you can detect and overcome the loss aversion bias? By making a disciplined approach to investment. By implementing a disciplined approach so that you make decisions based upon based upon a particular system that will help you overcome your loss aversion bias. Then comes overconfidence bias. Overconfidence bias is in which people demonstrate unwarranted faith in their own abilities. So you think that your predictions are very good, you think that your estimates are very good. So it may be intensified when you have a self attribution bias, that if your decision turned out to be good, then you praise yourself, you take too much credit for that success. But if your investment decision turned out to be poor, turned out to be worse, then you assign the responsibility to someone else. You assign the responsibility to some analyst, or you assign the responsibility to your broker for that. So that is overconfidence bias. There are two types of overconfidence: prediction overconfidence and certainty overconfidence. Now, what are the consequences of overconfidence bias? You underestimate the risk and overestimate the expected returns, because you have more confidence, you are overconfident upon your own predictions, so you overestimate the expected returns. It results in you holding poorly diversified portfolio, because you have overconfidence in your own ability, so you hold under diversified portfolio. How you can detect and overcome the overconfidence bias? By properly analyzing your investment decisions. And you must be objective while you are making the decisions. You should not rely on your own intuitions to make the decisions. Next is self-control bias. It's a bias in which people fail to act in favor of your long-term goals, but instead they just focus on your short-term satisfactions. Let's say, the best example could be, instead of saving for the future, you end up spending the salary for your current satisfactions, by purchasing a car, by buying a home, or by partying on the weekends. So instead of saving for the long term, you are just spending your hard earned money for your short term satisfactions. Now, what are the consequences of self control bias? It's possible that you save insufficiently for your future, because you are just spending your hard earned money for your short term satisfactions. It's also possible that you borrow excessively to finance your present consumption. Now, you can detect and overcome your self control bias. You should make sure that a proper investment plan is in place, and you should have a personal budget. You should make proper budgeting decisions at the start of your month, at the start of a financial year. You should make proper budgeting decisions, and you should make your investment goals. Then comes status quo bias. It's an emotional bias in which people choose to do nothing instead of making a change. So you just maintain the status quo, you maintain the things as they are, and you decide to do nothing even when a change is warranted. So what are the over consequences of status quo bias? You unknowingly maintain portfolio with risk characteristics that are inappropriate for your circumstances. So instead of making changes, instead of acting and making changes to your portfolio, you just fail to do anything and you maintain the portfolio as it is. It's possible that that portfolio has risk characteristics which are inappropriate for your situation. You fail to explore new opportunities also. How you can detect and overcome the status quo bias? You should quantify the risk reducing and return enhancing advantages of diversification and proper asset allocation. You should make investment decisions based upon the analysis of your risk reducing and return enhancing opportunities that you have at your hand, and you should follow a proper asset allocation approach. Then comes the endowment bias. Now, endowment bias, it results in people valuing an asset more when they own it rather than when they don't. So basically, if you hold something, that means then you will value that thing more instead of when you are trying to buy that thing. This is particularly inconsistent with the economic theory, because economic theory says that the price a person is willing to pay should equal to the price at which that person is willing to sell the same asset. But instead of that, if you currently hold a particular asset, you would value that asset higher than the amount that you are willing to pay for the same asset to buy it. What are the consequences of endowment bias? You fail to sell certain assets because you are just valuing them higher than the current market price. So you fail to sell those assets and you are unable to replace them with other new assets. You continue to hold the assets with which you are familiar. For example, the founding families, they always keep on holding the stock in their company, in their own company, instead of going for new opportunities. It's because you continue to hold the assets with which you are familiar. It's possible that you may maintain an inappropriate asset allocation because you are just holding the assets that you are familiar with, and you are just ignoring the new assets. You fail to sell your current holdings, so you are not replacing them with the new assets. So it's possible that you are having an inappropriate asset allocation, and that is inappropriate for your risk tolerance and your financial goals. How you can detect and overcome the endowment bias? The effective way is, just say, if you currently hold a particular security, let's say if the security is trading at $500 a share and you are not selling it, right? So if you are not selling it, that means that you think that it has a higher value than $500. Since you think that it has a higher value than $500, you should buy more at $500, but you are not also buying it at $500. So if you are not buying at $500, that means you think that the $500 is a fair price for the security, or it's more than the fair price. Since it's more than the fair price, you should sell it at $500. So you should critically analyze the situation. If you don't want to sell it, you should buy it at the current market price. If you think that the value is higher than the current market price, you should go and buy more. And if you are not buying more today, that basically means that you believe that this security has this much value and you should think of selling it at this price. This is the last bias that we'll cover, the regret aversion bias. Now, what's a regret aversion bias? It's a bias in which people tend to avoid making decisions because of the fear that the outcome will be unfavorable. So they don't want to regret. Now, there are two cases. Let's say you make two decisions. The first decision is to not invest in the stock market. The second decision is to invest in the stock market. By not investing in the stock market, let's say you lose an opportunity to earn 10% higher return. So that is basically a loss for you, a 10% loss. In the second case, when you decided to invest in the stock market, by making that decision also, you made a 10% loss because the markets were down at that time. So you made a loss of 10% in both the cases. But in which case you will regret more? You will regret more when you invested in the stock market. You made a loss in both the cases. The loss was equal, 10% loss in the first case, 10% loss in the second case. But when the loss came from your decisions, when the loss came from your actions, it resulted in regret. So instead of making decisions, instead of investing in the market, you just decided that you will not enter into the market, and you resulted with the same loss of 10%. But in this case, your regret is not as intense as it was in the second case. So regret is more intense when the unfavorable outcome is the result of an action taken rather than the result of an action not taken. That means no action becomes your default decision. What are the consequences of regret aversion bias? You become too conservative in your investment choices as a result of poor outcomes on risky investments in the past. If you had some risky investments in the past and you had some poor investment results, they make you too conservative for the future. You engage in herding behavior. Herding behavior is basically when you are just following the public. So to avoid the regret, you just follow the public. You invest in those assets in which most of the public is investing at that point of time. How you can detect and overcome the regret aversion bias? To prevent your investments from being too conservative, you should recognize that losses happen to everyone. And you should keep in mind the long-term benefits of including risky assets in your portfolios. The returns will come from risky assets, but how much risk to take, how to manage that risk, that we'll study in the next reading, the risk management of investments. Now let's talk about how the biases that we have covered so far, how those biases impact the stock market as a whole. What is market anomaly? See, we have studied the traditional portfolio theory, we have studied the traditional economic theory, and we say that the decisions are made rationally. Every investor is a rational decision maker. So, depending upon that, we calculated some market characteristics, that this is the return that you can expect with this much risk. This is how the market should behave rationally. But when market deviates from your efficient market hypothesis, when your markets are deviating from efficient market, they represent abnormal returns that are different from zero, and they are predictable in direction. If your abnormal returns persist for more time than they should have, then that means there is a market anomaly. That deviation is known as market anomaly. Now, you could misclassify something as a market anomaly because of three factors, result of three factors. First is your choice of asset pricing model. If your asset pricing model is not appropriate, that means the deviation could be result of your poor choice of the asset pricing model, and the market in itself is efficient. Second one is your statistical issues. Same as the first one, the statistics that you are calculating for using your model, it could be the case that your calculations are wrong, or you are just you are analyzing the wrong statistics. That's also possible. The third one is temporary disequilibrium. The deviation from efficient market that you are currently observing in the market, it's possible that is temporary, that is not permanent. If that is not persistent, that means that is not a market anomaly, that is just a temporary disequilibrium. Majorly, we'll study three market anomalies. The first one is momentum. Momentum, it refers to the trending effects in the market, that if a particular stock has given a high return in the previous 2 or 3 months, then you expect the same stock to give higher returns in the short term also, in the short term future also. Momentum can be explained by availability bias, hindsight bias, and loss aversion bias. Then comes your bubbles and crashes. In bubbles, investors often exhibit symptoms of overconfidence, they overtrade, they underestimate the risk, and they fail to diversify. With overconfidence, investors become more active and they trade more, so that the trading volume increases and it creates a bubble in the market. Overconfidence and excessive trading in bubbles, it stems from confirmation bias, self-attribution bias, and hindsight biases. Investors misrepresent the profits in a rising market as personal skill, whereas it's just the result of a rising market. Selling at a gain will feel Selling at a gain will further validate your investment skills, but instead it will boost your overconfidence. The last anomaly that we'll study is value. Now, value stocks are characterized by low price to earning ratios, high book to market equity, and low price to dividend ratio. That means the stocks that have a high earning yield, stocks that have a high dividend yields, and those that have a high book to market value. Growth stocks are the opposite of the value stocks. A number of studies have happened and they have identified that the value stocks outperform as compared to growth stocks over a long period of time. The outperformance of value stocks is a market anomaly. If we compare the outperformance of value stocks with respect to a simple CAPM model, it may seem that the value stocks are outperforming the growth stocks over a long period of time. So it's a market anomaly. But instead, when we include a 3-factor model or 5-factor model from Fama and French, it results that value is just another factor to be considered while valuing your portfolio, while estimating the expected return. So value is not a market anomaly. It all depends upon the choice that you make while selecting your asset pricing model. If you select the simple CAPM model, then value stocks would appear as an anomaly to you. But if you select the farm and fence 3-factor or 5-factor model, then these value stocks, it becomes a factor in itself and the market anomaly disappears. So this is it for this reading. In the next reading, we'll cover the module Introduction to Risk Management. Until then, happy studying. If you are new to the channel, please subscribe and like and share this video so that other candidates can also benefit from this. Thank you very much.